Hello friends, welcome to our today's video which is on the introduction to the profit and loss account. This would be the third chapter of the big book which we are following, namely the Financial Accounting for Management 5th edition by Professor Ramchandran by Professor Kakani. Right? In the earlier two chapters, the first one was related to the introduction, whereas the second was talking about the balance sheet. So by this time we already know that the financial report card of any organization can be in form of balance sheet, which we have already discussed, income statement or the profit and loss account, which we'll be doing today, and then there is a cash flow statement, changes to equity, and then you have a notes to accounts, right? So the financial report card of any organization can be segregated or can be of these four types. So one out of them is the income statement. So the discussion for today's video would be relating to the income statement or the basics or the fundamentals or introduction to the income statements. Assuming that you are an accountant or a manager of an organization, you are basically responsible for the bookkeeping activities. Now, if I ask you one question as to what would be the questions which are asked by the owners or managers or the users of accounting information, even any user of accounting information. What can be the types of questions which are being asked by the owners or managers to the bookkeepers? The first question was it a good year or a bad year in terms of your revenue, in terms of your expenses, in terms of your overall profitability or your growth, right? This would be the first question which is generally asked by the owners or managers to the record keepers or bookkeepers or the accountants or the preparers of the financial statement. Then they would also ask you as to what was the volume of operation, in other words, what was the sale from the regular operational activities during the year, right? Then there would also be a question as to how much is the profitability or what is the margin which is available on the sales which has been realized, right? The answer to all these above questions would be the profit and loss account, because the profit and loss account is an account which talks about the profit or loss which has been earned or incurred by an organization during a particular financial year, right? So what is a profit and loss account? A profit and loss account, it shows the company's earnings and expenses over a given period of time. You need to understand these three things. These are the earnings from operational and other activities, various activities of an organization. What are the earnings? What are the expenses which have been incurred in order to make these earnings? And what is the time period for that? We have seen in our earlier classes that the time period would be a period of 12 months, starting from 1st of April, ending on 31st of March the next year in case of Indian companies. And many companies or many foreign companies do follow the financial year starting from 1st of January and ending on 31st of December. It exclusively summarizes, it is a summary, not all the transactions are recorded. Summarizing the revenue and expenses. What does this mean? It doesn't show all the expenses or all the revenues. Say for example, in the month of March, my sale was 20 lakhs. In April, it was 40 lakhs. In May, it was 60 lakhs. In June, it was 10 lakhs. So I don't show these sales in the profit and loss account or the income statement. What I do is I show the total of these revenues and total of these expenses during this period. And then we talk in terms of the net difference, which would be either the profit or loss from that period, right? So it is a part of the final accounts which are drawn up at the end of the accounting period. So what is a profit and loss statement or profit and loss account? It is a statement which talks about the summary of earnings and expenses. It shows the net difference in terms of profit or loss, and it is prepared at the end of the accounting period, which is as on 31st of March. This is for the year. If you remember, in the balance sheet, we have mentioned the terms as at 31st of March. In this, we say profit and loss account for the year ending. For the year ending 31st of March, say 2023 in our case, 2023. In case of balance sheet, it was balance sheet as on. This is the difference. So balance sheet is a snapshot as on a particular date, whereas income statement is for the whole year. Summarized statement for the whole year, the transactions of the whole year, right? It establishes the net earnings or net loss of the business. Now, let's see what a measurement of income is. This income statement or the P&L account says, what it does is it compares the revenue from sales against the cost of resources. What is this? This is nothing but the matching concept. Matching the revenue, what we have received, from the cost, what we have paid during a particular year, right? The net difference represent the income, profit, or if it is negative, my costs are higher, we would say it would result in the loss, right? So how it does? What income statement or what P&L account does? It identifies the realized revenues as to what revenue has been generated during the year from various activities performed by the organization. Then it sees what are the expenses that have been incurred in order to generate this revenue, right? And it matches the identified revenues with the expired costs. What it does is it matches the revenue with the costs. It compares and then it gives you the result. Either it would be a profit or it would be resulting in the loss. So income statement or the profit and loss account statement is a statement which measures the income by realizing or identifying all the revenues, comparing it with all the expenses which have been incurred in order to generate those revenues, and then after matching it would tell us as to what has been the profit which has been made during the particular year, or what is the loss which has been incurred by all the activities by the organization or the business. So let us summarize as to what we have done. We have seen what is a P&L account is. It is a report card. First thing, what it shows the profit or loss during a particular year. What is it? It's a financial statement. It's a financial statement. What are financial statements? These are the report cards which talks about the results of an organization for a particular year in terms of profit or loss. Why is it prepared? It is prepared in order to find out where we are in terms of growth or profitability. Are we moving ahead or we are going backwards? This is the reason why it is prepared. The report card is prepared. When is it prepared? At the end of the year. Generally on 31st of March. But it is prepared for the whole year, for the year. Prepared at the end of the year, but it is prepared for the year, which means a period of 12 months is taken into consideration while preparing the income statement or the profit and loss statement. Who prepares it? Obviously the bookkeeper or the accountant or the accounts team or the accounts department of any organization who are responsible to record the business transactions. Who uses it? All the users of accounting information. Users of accounting information. We have seen these users of accounting information can be internal to the organization, they can be external to the organization, right? We have seen in our users of accounting information that different types of users have different types of objectives or mottos for taking out the information from the financial statements. So there are different types of users having different objectives while going through the financial statements, especially the profit and loss statement. So this is all about the profit and loss account, the introduction to profit and loss account. In the next class, we will be talking about the important concepts or important principles which are required to be followed. These are basically the rules or assumptions that needs to be kept in mind whenever we are preparing or whenever we are recording the transactions related to the income and expenditure, or whenever we are trying to prepare the income statement or the profit and loss statement, right? Thank you so much and bye.